Hello and welcome to Morningstar. Today I'm joined by one of the most famous names when it comes to investing in disruptive innovation, the founder and CEO of ARK Invest, Cathie Wood. Thank you for joining, Cathie. So markets are under pressure. A growing number of investors wonder if the AI sector stands at a significant inflection point today. There is a mounting concern that the near future might be defined by lower growth, higher competition, and greater capital intensity. In your view, are we witnessing bubble signals similar to the late 90s? I mean, is this just another volatility cycle investors must deal with, or a fundamental regime shift?
Well, I can talk with some experience. I was in the bubble, investing, portfolio manager during the bubble. And what we witnessed back then were investors throwing money at any company with .com or internet in its description. Today couldn't be more different. We are climbing a wall of worry. Investors are very hesitant to continue fueling the AI boom because they're worried that we are in a hype cycle. As a portfolio manager, I would much prefer to invest in that kind of market. Why? Because walls of worry, climbing walls of worry, those are the most durable bull markets. And I remember as way back in the 80s and 90s, those were the kinds of bull markets we were in. In the late 90s, that was an irrational, out of control end to a massive 20-year cycle.
Both the dot-com boom and today's AI surge were built on a new revolutionary technology, but also on belief in American economic and technological dominance. Do you think this view is still tenable, given the huge progress China has been making on that front? We have now Chinese tech companies releasing new AI models with the market eagerly awaiting the one from DeepSeek. So do you see American exceptionalism to continue driving innovation leadership?
Well, I do agree that China is the competitor. The DeepSeek moment was a wake-up call for all of us to understand that that what China has done actually has been encouraged by our software companies. Our software companies stopped selling into China because of fears of IP theft. So they moved into the open source movement, and they are running hard with it. We are big believers in the open source movement. Now, in terms of competition, we think competition is very good for the United States. That's when we're at our best. And so I think the AI revolution is occurring faster, perhaps, than otherwise might have been the case because China is so advanced. Many experts would say China is about 6 months behind the U.S. in terms of the frontier models, and our research corroborates that. We're seeing leapfrogs, China kind of encroaching on the U.S., but then the U.S. moving further ahead. Again, competition is good. I think it's encouraging faster momentum in the cycle. And just to answer one other way, the previous question, if you think about the tech and telecom bubble in the late 90s, that was all about laying fiber for broadband connectivity. Well, that fiber was dark for many, many years. There was just too much too soon, too few opportunities. It's completely different today. Every GPU in the world is being utilized. And I do think it's this dynamic China-US competition that is speeding the revolution along.
Interesting. And as an investor, do you see this risk-off environment as a buying opportunity? And in general, where do you see the most compelling opportunities within the artificial intelligence industry right now?
Well, I would have to say that the opportunities are more in embodied AI, meaning bringing the physical and the digital together. And so autonomous mobility, we think, will be the biggest revenue generator. It'll scale the most quickly to the $10 trillion mark, which is quite meaningful in a world where global GDP is about 130 trillion. We think that will happen within the next 5 to 10 years. And this movement has happened slowly, and now it's happening all at once. Elon Musk was talking about autonomous mobility in his master plan 12 years ago. And here we are. Finally, he launched this year. So slowly. And now he's saying by the end of this year, depending on the regulatory environment, Tesla will be autonomous in 25 to 50% of all of the U.S. major cities. So that's one. And then the other one is in healthcare. While we may see the scaling of revenues the most quickly in autonomous transportation of all kinds, we think the most profound applications of AI are going to be in healthcare. And from a regulatory point of view, here in the United States at least, we're just strangling the healthcare sector, and with too much focus on safety and not enough on efficacy.
Well, as you mentioned, you remain highly bullish on robotics and autonomous mobility. Even though we have to say adoption has been slower than expected. If we go back in time, just a decade ago, many forecasts stated that self-driving vehicles would be everywhere in the 2020s. Today, of course, it's not the case. So where do you see the biggest constraint today? Economics, regulation, technology? And you also mentioned Tesla. Of course, it's a short leap, from robotaxis to Tesla. So what are your expectations in terms of longer-term return potential from Tesla?
Well, we are in print on Tesla. It's in the low $400 range per share right now. And we are in print. Our 2029 forecast is 2,600. That forecast has nothing for Optimus. So humanoid robots. And we're beginning to understand that while we were too aggressive on autonomous mobility, so robotaxis, we may be too conservative on the humanoid robot opportunity. So stay tuned for that update. The slow, and then all at once is very typical of technologies that really are hard to crack. I think Elon Musk genuinely thought that by the late teens, 2018, 19, he would be in there with robotaxis. We had just experienced a massive breakthrough in AI, transformer architecture in 2017. It has taken time for Tesla, Elon and team, to perfect the autonomous opportunity with the latest AI breakthroughs. Now we're there. And so we don't think technology is the problem anymore. We are seeing autonomous vehicles on the road. I can drive around in St. Petersburg with my current Tesla, full self-driving, and not touch the wheel or the accelerator or the brake, and I can park. So the technology is here. Regulations have to catch up. In the United States, we have 50 regulators, well, more than that in transportation, but 50 state regulators. We think that this government is going to elevate the regulatory regime to the federal status. And that is because autonomous vehicles, of course, cross from state to state. So it should be national transportation regulation. If we do get that, we believe that Tesla will be in certainly more than 25%, but probably up to 50% of all the cities in the United States, the major cities, and beyond, because, of course, Tesla's data is worldwide. The roughly 7 to 8 million robots that we all drive have been collecting data for years. I got my first Tesla Model 3 in 2018, and it has been collecting data every day and sending it back to Tesla. So Tesla knows the world's roads from a data point of view, we think, better than any other auto manufacturer or technology company out there.
Interesting. Speaking of Elon Musk, a couple of weeks ago, there was this record-breaking merger between SpaceX and xAI, two companies both included in the ARK private innovation portfolio, a strategy that you recently launched in Europe. So what's your take on this operation? What do you expect from it? And do you see Tesla potentially part of this whole project in the future?
We began to get the sense that Elon is looking at the convergence among his companies very seriously. Convergence is a word we've been using in our big ideas we started in 2017, but the idea of convergence, that word really surfaced within the last 5 years. And Elon on X said, I think my companies are more convergence candidates than I even appreciated. That's when we knew that he was thinking carefully about all of the data sources he has that nobody else has. And AI, if anything, is a proprietary data project. Those with the proprietary data and the most of it and the most differentiated are probably going to win. So that's very big picture. In terms of SpaceX and xAI, when Elon started talking about orbital data centers in space, that's when we got the sense that this was a real possibility, this convergence. It happened more quickly than we expected. And yes, of course, it begs the question, will Tesla be next? We think that Elon would like to reward the very patient shareholders who have been holding Tesla for the last several years with the profitability associated with robotaxis. And so if Tesla is a part of this convergence strategy, and it could be, we don't think it will happen for a number of years. I think he'll want to integrate the space opportunity first. But the frustration of building data centers on Earth finally took Elon Musk back to first principles. Could we do this in space? There are no regulations in space. We could do this very quickly, much more quickly. And while we don't think he will have as many gigawatts of computing power up in space as he thinks by the end of the decade, we think he'll be well on his way by the end of the decade to meaningful computing power.
Let's talk about cryptocurrencies now. Bitcoin has lost roughly 45% since its peak in October. The overall impression is that the market narrative around Bitcoin has shifted compared to a few years ago. And that's probably because it trades like high beta tech stock. So do you still consider it as a longer-term monetary asset? And if so, what is the market misunderstanding?
Yes, we do believe, and our conviction has increased, that Bitcoin is the first global, digital, private, meaning no government oversight, rules-based, most important part of it, monetary system in history. That is a very big idea. Now, what has happened in the last year or so, stablecoins have been usurping one of the roles that many of us thought Bitcoin would play. In the emerging markets, people who are living hand to mouth, meaning they don't have a lot of savings, they would much prefer the dollar, and stable coins are backed pretty much 100% by dollar or dollar-based assets. And so that is their preferred insurance policy against their own currency's devaluation and the loss of purchasing power and wealth. So from that point of view, in our long-term forecast, which our bull case for 2030 has been $1.5 million, that would have taken $200,000 to $300,000 off of that price target. But what else has happened in the last year? We've seen gold really go parabolic, and Bitcoin has not done the same. Well, how can that be? It's digital gold, we thought. Well, if you look at the correlation between gold and Bitcoin, you'll see it's very low, especially since 2019. Since more traditional investors have been getting involved with it, the correlation is 0.14, so almost no correlation. But if you zoom out and you look at the longer term price chart of Bitcoin, what you'll see is gold often leads, and certainly in the last two cycles, Bitcoin's performance. So gold is a leading indicator in at least the last two cycles. We think the other thing going on is we're seeing a lot of OGs selling. Those who were very early adopters of Bitcoin are selling. Now, why are they selling? Well, according to some of them, Bitcoin has lost the plot. Too much traditional finance or financial players are getting involved. And from our point of view, all along, and this is in our collaboration with Dr. Arthur Laffer, known for the Laffer curve, he has said the more that Bitcoin becomes involved in the traditional financial ecosystem, meaning traditional financial institutions start adopting it, the stronger his conviction will be that it is indeed the new global monetary system I described. So our conviction has actually gone up as Bitcoin has gone down here.
Now, your whole range of actively managed ETFs provides exposure to disruptive innovation, including some niche sectors such as space exploration or genomics. Which part of your portfolios would you most expect to surprise investors on the upside, and which area worries you the most if adoption timelines slip?
I would say this is a hard question to answer, but you can tell from price action recently, let's just say in the last year, anything with space and defense tech has had very strong performance. So the market is beginning to understand how big that opportunity is. And the same thing with AI. So our AI and robotics fund, ARKI, over the last year or two, that has done exceedingly well. True, it's had a correction. And from our point of view, this is more a buy the dip moment. The fund that has been the most challenged, and therefore where we're seeing the most skepticism, is the genomic fund, ARKG. And as I mentioned before, we believe that the most profound application of AI will be in healthcare from the point of view of collapsing the cost and time to discover new drugs. So going from 2.4 billion, including failures along the way, down to 600 or 700 million during the next 5 years, and going from 13 years to 8 years or less.
Finally, if in, let's say, 5 years, we look back and ARK's core thesis didn't play out as expected, what do you think the most likely reason will be? Timing, regulation, competition, human behavior? What's the biggest risk here?
The biggest risk is more macro. As I think I've explained before on your show, our models are focused on something called Wright's Law. And Wright's Law helps us figure out the learning curve associated with each technology, robotics, energy storage, AI itself, the biggest catalyst out there, blockchain technology and multiomics technologies in the life science space. And those learning curves are expressed in cost declines. Those learning curves depend very importantly on unit growth. If we went into a worldwide depression, I think that would delay these technologies. The irony is, during a depression or a serious recession is when many companies are looking for new ways of doing things, faster, cheaper, more creative, more efficient, more productive. And so the adoption, even though the unit growth dynamics aren't there, the mindset develops. And so we usually come out of those periods flying. These new technologies do. So a recession, a bad recession would slow progress down, but it would not stop it. In another way, it would help evolve a coiled spring so that the end of the recession would be a massive takeoff in these new technologies.
Very interesting. Cathie, thank you so much for your time. Appreciate. For Morningstar, I'm Valerio Baselli. Thanks for watching.